Hello, my name is Dick Jones. I'm the tax problem guy. I've been solving tax problems for 26 years, and some of them with individuals, some of them with corporations. But the main thing that gets people in problems and causes them to go out of business is not being able to pay their payroll taxes. Well, that is a major concern. Do you pay the rent if you don't have all the money, or do you pay your payroll taxes the way you're supposed to? The right answer is you pay your payroll taxes. What most people do is pay the rent so they can stay in business and hope that they can pay the taxes down the road and try to play catch up. Well, let's say you're a corporation. We're going to talk about trust fund taxes today and let you know just a little bit about how the trust fund works. Trust fund penalty can be issued if you're a corporation against anybody that is responsible for those taxes. Now, that's not always the owner. Usually, generally, in a small business, it is, but it could be the secretary. It could be the president of the company that's not working in the company, and it could be all three or any of the above. What a trust fund penalty is the amount of taxes that you take out of an employee's paycheck to turn over to the government. Now, that excludes the amount of FICA taxes and Medicare taxes that you have to match for the employee. So let's take an example of, let's say I'm working for a corporation and you take out $50 in taxes on me, and let's say the FICA taxes and Medicare were another $25. So on that particular week, you owed the government $75. Now you're at a point where you can't pay your payroll taxes, and a revenue officer comes in and they take what they call a trust fund interview. Well, that is to determine who has the trust fund liability. It could be the secretary, it could be the owner, it could be a president offsite, it could be all three, whatever. Whoever's actually responsible for signing the checks, making the day-to-day decisions on who gets paid, what gets paid, and that's usually who the trust fund is issued against. But IRS is wanting money. So I would say most generally in my example of the president, the guy that runs the company, and the secretary, if the secretary has the ability to sign checks, to pay over the payroll taxes, make decisions on who gets paid, I would say they would shotgun all three. So in that case, they're going to issue the trust fund penalty, which would be the $50 in my example that they took out of my check and not the $25 that I had to match. So you're going to get three people that are going to be sent a notice that they owe this $50. Well, if you get it from all three, that's $150. Government cannot do that. They can get it one time. So let's say the president of the company off-site has got the big pocket, and he says, I'm not messing with this. I'm not going to get a tax levy against me or a tax lien. It will embarrass the heck out of me. I think I'll just pay that. So he pays over the $50, and the secretary and the manager of the company then are off of the hook, because it only has to be paid once, even though there's been more than one trust fund notice issued against other people. Or let's say they decide that we're all in this together, we'll all pay a third of it. So they pay their third and it's all done. So that's how trust fund penalty works. It does not work if you get behind with payroll taxes and you are self-employed or a sole proprietor. So if you have questions about a trust fund, call me at 573-341-5578 or taxproblemguide.com on the net. Thank you.